Thank you, everyone, for joining us today. My name is Brian Knight. I'm the Associate Director for Financial Policy at the Milken Institute's Center for Financial Markets in Washington, D.C. I'm joined by an august panel today to talk about innovative financing. The past few years have shown a real explosion in both capability and diversity of innovative means for small and medium-sized businesses to access capital. Beyond traditional bank loans or the traditional securities markets, we're seeing a collaboration between technology, creative, legal and business logic, and a change, arguably, in the culture where individuals and smaller investors with less money to invest, are being much more directly engaged by businesses seeking investment. Where this goes, what this means, how this might impact more traditional means of financing, what the regulatory response to this is and where it may go, and what this might mean for small and medium-sized businesses in the future, particularly as groups like banks have retrenched from small business lending, though there is some indication that might be coming back, is an important question for both finance policymakers and the businesses and employees. So I'm very honored to have this wonderful panel here today to talk about what they're seeing. I'll start here and let them introduce themselves, and then we'll get down to business. Rob?
Yep, thanks, Brian. So I'm Rob Young. I head international for OnDeck. OnDeck is a platform that has been established about 7-8 years ago, and the focus is entirely on small business. So we lend to small businesses. Today in the US and in Canada, and very shortly in Australia. And essentially what we've done is we've built a technology platform that innovates on the process side. So we make a small business owner applying for credit faster, quicker, easier, more convenient. And we've also innovated on the credit side. So we use a lot of data points to be able to make a kind of a real-time decisioning process to grant credit, grant access to capital to that small business owner. Business went public in the US and the New York Stock Exchange at the end of last year, and is now expanding internationally outside of the US.
I'm Lucy Vernall. I'm General Counsel and Head of Compliance at Funding Circle. Funding Circle is the UK's largest marketplace in the UK, connecting a variety of investors who want to lend to SMEs. So we're the largest SME marketplace in the UK. We're also in the US, had a US business for just over 2 years. Again, we're similar to OnDeck. We're using technology to do what we're talking about today, really, to make sure that those who want to provide capital are connected to those who really need it. We've been regulated by the FCA since the 1st of April last year, so I'm probably quite well positioned to talk about regulation and how that impacts on fintech, which is one of the things we're going to be talking about today.
Good afternoon, everyone. I'm Shalini Khemka. I founded a business called E2E Exchange, Entrepreneur to Entrepreneur Exchange. Started it in 2011. Our main reason for being is to help entrepreneurs to get connected to extraordinary people. So the whole business is around creating connectivity. We have 3 key arms of the business. One is E2E Invest, where we help companies raise funding. So unlike my esteemed colleagues here, I don't do innovative finance, but we introduce entrepreneurs to innovative financiers, venture capital firms, private equity firms, and angel investors. The second arm of my business is E2E Exchange. It's a not-for-profit business to help promote entrepreneurship across the UK, and hopefully we can follow on in the footsteps of the Milken Institute in time to come. The third arm of the business is E2E Exec. It's about getting non-exec directors, chairmen, and mentors helping growth companies. We focus on scale-up businesses that are making 20% year-on-year annual growth. And what I like to see it as an institute of entrepreneurship with access to funding and access to people. So that's a little bit about me.
Good afternoon, everybody. My name is Tom Davies. I'm the Chief Investment Officer at Seedrs. Seedrs is an equity crowdfunding platform. We launched about 3.5 years ago here in the UK. We are now open throughout Europe, and we will be shortly launching in the US. We know regulation very well. The equity space is the most regulated sort of part of this equation. We were the first platform to get regulated. It only took us 3 years. And essentially, since then, we sort of designed the model which others have been following, which is great. And essentially, in a nutshell, any entrepreneur who's looking to raise money for their business can submit a pitch to Seedrs, and anyone, including anyone in this room, can invest in that business and actually own shares in that business. And the minimum investment is £10.
So I somewhat buried the lead in my introduction because I just I mentioned innovative finance as if it was a defined term, and of course we haven't done that yet. So that's what we're going to do now. So, and we've talked, we have some different business models present and some different perspectives here. So let's sort of quickly run through when you say innovative financing, what do you mean? What makes it innovative? Because obviously a loan, loans have predated this, and equities have predated this. So what is innovative about what we're seeing now? Tom, let's start with you.
Sure. I mean, I think we look at it from two angles. There's the technical solution. So there's a lot of tech involved, and the ability to lean into technology to enable anyone to invest in an efficient, in a compliant, in a cost-efficient, easy way is part of the equation. The other part to it, though, is the innovation comes in using regulation and actually lobbying for regulation to be changed to actually catch up with the modern day world. And I know the US, as we were just chatting before, is a little behind this. And I know a lot of securities law still talks about sort of delivering letters by horseback and so forth. So it's trying to bring that into the 21st century and get to a point where there's a lot of inefficiencies in the marketplace, which are a result of legislation. And it's trying to bring legislation and the inefficiencies and solving the two through a technical solution.
So we'll go over to the lenders now, and then I'll double back to get the entrepreneur perspective. So Lucy, from your perspective, what makes what your engagement with funding innovative?
Yeah, I think I'm absolutely right that innovative finance does cover a huge number of different business models. And I really agree with Tom actually around the use of technology to provide actually something that's always been there, and use of technology and also the use of data in a way. And what I can talk about most, because what I know is marketplace lending, and that's using technology to do something in a quicker, in an easier, in a more simple way, and also in a very transparent way, which I think is one of the things that will get people more comfortable with the model. But I think also, as we said, the use of regulation, which I think we'll talk a little bit more about later, but is incredibly important for the industry, so that it can grow safely, so that you don't have rogue players, so that people have, whether it's my industry or Tom's industry or Rob's industry, so that there are kind of consistent protections for investors, because it is all about kind of using that technology for investors, those who want to provide the capital to those who need the capital, and making sure there's regulation there to keep that consistent, but also in a way that the regulators actually understand, because that's what's really hard, I think, about what we're doing, because there are so many different business models, even with the peer-to-peer lending space. Nearly everybody in the UK has a slightly different business model. So to then go to a regulator and say we want to be regulated in a balanced way, in a way that protects people, but actually we're going to be constantly innovating and changing. Can you provide something that will work? Is tricky.
Yeah, I mean, I think for us, I would pick up two examples as kind of where this innovation for us, realizes itself. One is we've developed this thing called the OnDeck score, which is basically a credit score for small businesses, right? And so the innovation there is, it typically was very hard. In our case, small business really means small business. I mean, you walk out of the street and it could be the florist down the road, or it could be the hairdressing salon, it could be the shopkeeper at the corner, right? So how can a bank, with all of its costs and all of its kind of processes, actually look to that small business owner and assess the health, the financial performance of its business? Well, actually, a lot of these business owners, just like a lot of us as consumers, are using the web more and more, and kind of our data imprint is being left there. And if a customer of a small business owner enables that to, in our case, a lending institution, you can use that data to help assess make a credit assessment. And in many cases, that credit assessment is going to be more unbiased maybe than potentially what a loan officer could do, potentially. So I think there's innovation there. I think the other side of innovation, which I think is really interesting, is a lot of platforms like ourselves, like Funding Circle, like Circles and E2E, like Seedrs and E2E, Our heartbeat is a technology team at the core of the business, right? So if you see a lot of the innovation that's happened, I know, in e-commerce, et cetera, it's been technology groups that have then moved into specific verticals like commerce, and they've disrupted that space. And in our case, the way we run our business, how product is developed, how we react to customer preferences and design something new and test it, that is very different to how a bank or a traditional financial institution operates. And so I think the innovation is there because we have that kind of more tech-driven approach to deriving solutions for customers.
So we've heard from the industry participants, but of course, the real proof is in the pudding. From the entrepreneurial perspective, what are you seeing? Are you seeing anything where entrepreneurs are looking at these solutions and saying, yeah, this serves my need better than the traditional options?
Sure. I think, firstly, from the entrepreneur's perspective, they probably don't think of things as innovative finance. Mm-hmm. The terminology is not important to a founder. What the founder is looking for is, first of all, it's a minefield out there. Who do you go to? Do you go to Funding Circle? Do you go to Seedrs? Where do you go? Do you go for debt finance? Do you go for equity finance? So first of all, in terms of looking at this part of the problem is access to the right advice. Mm-hmm. And my colleagues here obviously are giving advice, but I think that's the first aspect of it. The second aspect of that is, once they've had the advice, is what are the problems in the small print? Understanding the risks. Understanding the risks that if they're going with a particular firm, what are they signing themselves up to? And I think organizations that are allowing entrepreneurs to access capital in the innovative ways that's happening today, whether it's crowdfunding, debt financing through a crowd, they're all great. And entrepreneurs actually love the opportunity to access money from different places. But it's a case of, where do you go? Where do you seek the advice? And what's the right channel? What's the risk in that? And I think we should broaden our view on sort of innovative finance. If you look at microfinance, that's innovative. If you look at high impact financing, that's innovative. So what stage is the entrepreneur at in their life journey? Are they very early stage or are they very developed? And how are they doing it? My friend is sitting here at the front, Basim. He is offering finance through mobile technology. So the world is changing really quickly. The question from the entrepreneur's perspective is, which route suits what they're doing? How much are they looking for? What are the risks in that route?
See, we can get another chair up here if you'd like to hop on. Yeah, sure, hop on it. Well, so to paraphrase badly Bob Collingworth's Farcom, need drives innovation.
Sure. So
let's talk about, there are banks, there are public markets to varying degrees in varying countries. There are traditional private markets for securities. What is the need that these platforms detect? Why is there a need for these platforms? What failure, what market failure are you guys solving for? Yes.
Can I start, and I'll let my
Absolutely.
My I think partly the crash of 2008 and the fact that banks weren't able to lend has had a real impact on the change and the growth of organizations like Funding Circle and Seedrs. So I think the regulatory environment changing will also impact the way they grow and how they're dealt with. So I think historic reasons have created a need, and we need, as founders of businesses, we need access to money. So we're going to find whichever route possible, and investors are finding clever ways to access the entrepreneurs. Mm-hmm. That's, I think, part of the reason for these changes.
I think looking at it from the equity angle, it's an interesting question, and I think it's got something to do with, it's a very generic term, disintermediation, and everyone talks about Uber disintermediating and Airbnb disintermediating. But I think what it is we've often seen, particularly in the angel investing space, a reasonably large amount of capital controlled by a very, very small subset of the population who are deciding where it goes. And I think what we've tapped into is the top 1% of wealth, which is traditionally the very rich people who have been able to invest in this asset class of startups and growing businesses. What we've essentially done is open that asset class up to the top 20% of wealth. The people who aren't millionaires, but they might have $5,000 a year to spread across 10 different companies. And that's a hell of a lot of capital. And I think the reason why there's demand on the investor side is, with Seedrs, you actually get to see exactly where that money's going. You get to pick the team, and you see it grow. A lot will fail, and that's fine. But rather than it going into some VCT and a whole bunch of fees get trimmed off and you get hopefully something back, I think people are wanting to take charge of their lives, be it how they get from A to B or where they stay. And I don't think that's any different really in where they put their money.
I think that's, again, agree with both of you. I think there's a bit of a perfect storm, really, with the banks retrenching after 2008 and just being unable to provide the finance to SMEs who clearly still need that finance. The advent of more and more technology and the availability of data, which enables there to be the different types of financing. And then, as with Seedrs, see the ability for investors to actually provide that capital that's needed in different ways, which just wasn't possible with the traditional methods of financing. So that's going from the retail who for the first time are able to put £100 in and see it go to a small business, which they can choose, or they can actually have an automated tool and just let the platform do it for them. Right up to different, again, sources of finance, but different from the traditional sources of finance, who are able to connect directly, certainly in the marketplace model, with those borrowers who need the capital. So it's kind of those market conditions, and then, again, small business lending, because it was needed, has been a political darling, really, which has been, again, very helpful to us as a business, particularly, because politically people want to see that capital being made available to small businesses. So there has been help with Treasury and with regulation to make sure that this industry with the right players can actually flourish, which has been really helpful.
Yeah, I think all of those are valid reasons, in terms of need. In our case, I guess, and I've met a whole bunch of our customers, and what keeps coming back is, in our case, you guys are just fast, you were just quick, you were easy, you were convenient, right? So in the kind of era when, we're all used to dialing our phone and getting the latest Netflix kind of series on demand, the small business owner, time is at a premium, and that's valuable. Their time is valuable because they want to be dealing with their customers and stuff. So they don't want to be going through a 2 or 3 week process with a bank, which is a little bit obscure, and you have to ask for a time to meet the officer, and then you've got to explain their business. Maybe that officer, has moved to another region, and you had, built up a relationship with them, then they're gone. And then the bank, manager is going, well, I need this 15 list of, show me your 3-year business plan. And the florist is going, what is a business plan? I don't know, I can show you my numbers. So, you're solving for a lot of those things. People want access to capital now and quickly. And so they're willing to trade off other things. Maybe it's not as cheap as the bank, right? But maybe that hassle factor gives them a chance to use that capital more productively, because they've got an opportunity that they want to buy some stock at a cheap discount that's arisen, and that's going to be there this week. So in our case, it's along those lines, as well as some of the other ones.
Okay. So we have, there's a lot of innovation, but one question that comes up is who is benefiting from these services? Are there particular types of businesses that are being benefited by these, and others that perhaps are not as well served? Are these different business models better suited to certain types of recipient business models? And where do you see it going? Is it going to remain somewhat niche-y, or can you see it spreading out to more and more different types of businesses? Tom, we'll start with you.
I think I think that it's usable by a lot of different types of businesses, but I think that doesn't mean that it's usable by everybody. And I'll give you a good example. We've funded everything from Mike's Fancy Cheese, who's this Northern Irish guy who wanted to make the first artisanal blue cheese in Northern Ireland, and he did it, and he's doing really well, and he's now selling it in Portland Masons, and that's great. Right the way through to back-end data SaaS solutions and so forth. So we cover a broad spectrum. Last year, we crowdfunded Chapel Down Wine. It's I know to Americans this is going to sound like the sort of Saudi Arabian downhill ski champion, but it's a very good English winemaker. And basically, they decided to crowdfund rather than use the public markets, and they're already a listed company because they wanted to access capital from their customers. And they basically wanted to have customers locked in as shareholders, and they wanted to acquire new customers who were potentially interested in investing in them, and it worked very well. So that worked great for the wine company that had a loyal base of passionate customers. It wouldn't probably work for the copper mining company. And I think that's the distinction at the moment. But within that subset of people that it is appropriate for, it's people who really want to raise money from people that also will be bought into the passion and the product and the service and basically be marketeers of that and advocates of that product. So from us, crowdfunding is not just about raising money, it's raising money and all the other ancillary benefits, and that's applicable to a huge group of potential companies.
From the equity perspective, is there a business model or a growth projection or something like that, an expected liquidity event that really you need to have for that to make sense, or are you seeing success across different models? Well,
interestingly, we've been going 3.5 years now, 0 exits, and that's perfectly normal. Our first vintage in particular is very early stage businesses, so we're not expecting that yet. And yet, with 0 liquidity events, essentially, the average number of investments for every investor who makes more than 1 is 9. And I think that's really interesting. So there's something that's going on there that's wanting and making them come back. And I think what it is, it's, there are lots of mini successes in a business as it grows, other than just getting a check back in the post. And Seedrs is a good example of that. We crowdfunded ourselves 18 months ago. We've just raised a new round of finance, and Neil Woodford invested, and that's great. That is a success in itself, and that makes all those original shareholders feel good and warm and fuzzy. And I think there are other things that you can reward your shareholders and investors with other than just the check, which hopefully is going to come in the end, but we're under no illusions it's going to take a while.
So let's switch over to the lenders, and then we'll come back around to the entrepreneurs. So from the lending perspective, are there businesses or types of businesses that you see being uniquely well-suited to your product or are not well-suited to your product? And what do they look like?
Yeah, I think, in our case, I alluded a little bit to, probably the driving factor is the speed and convenience. I think if you're a business of a certain size, you've got, a finance director or CFO, and they have the time and the resources to be able to go and look at all the options in terms of credit and so on, then perhaps, and time is not of the essence, then they may be solving for something else. It might be size of credit facility, or it might be the credit facility comes with other banking services, that in our case as a focused lender, we wouldn't provide. So I think that's, that's not going to be a great use case, in terms of our product as such. But I think, in terms of what we focus on, it is the 95% of small business, of business incorporated entities in the US, in practically any country, is formed by small and medium-sized enterprises, right? So there, the hassle factor and the access to capital is much more important. We know, to me, it's fascinating that in the US, which is a country that obviously is highly liquid in terms of credit. There's a lot of availability of credit, and yet we're able to identify, underserved businesses that need credit. For example, we did there was a report published on our first $1 billion of capital that we lent by the analysis group, a third party, which showed that $1 billion of lending had a $3 billion impact on the economy in terms of added value, and had contributed to 22,000 jobs. So, that's capital that otherwise would not be getting lent or used by that kind of productive sector. So, if that's the case in a country like the US, where there is so much access in general or credit availability, in other countries where that gap is even wider, it shows you the impact that could be had from platforms like all of us.
Yeah, and I think we're slightly different in the target borrower from the equity crowdfunding. So there are certain criteria that you would need to satisfy to borrow on our platform. The main one of those being you need to have been in business for 2 years. So we're not very, very early stage. Subject to that, in terms of small businesses, again, I think like OnDeck, any small business can use our platform. It is quicker generally, it is simpler, it is transparent, but that's one of the things our borrowers would go for. But it's not so different, certainly in terms of price. So we're not kind of more expensive than the banks. But then you know, we see all industries. We see a huge variety. I think, I don't think we've got the first cheese. Well, obviously you've got the first cheesemaker in Northern Ireland, but there, you know, lots of kind of small drinks providers, small kind of hat makers, and for a number of our lenders, it is that sort of the same exciting story in terms of investing in the borrowers, and the borrowers love that kind of, you know, I've had these people investing, but equally we have a number of borrowers who, you know, it's just another means of getting finance. So there's slightly different story from the equity one there. So it's probably a little bit of a wider range and across every single industry. We don't see one particular industry coming to us more than others. So any small, medium-sized business and that's sole traders as well as limited companies.
Just to add to that, what's quite interesting is we're seeing a lot of businesses that I think will probably end up on Funding Circle and perhaps OnDeck actually in the future, because I don't think there's one platform for one company for its entire life. I think the alternative finance kind of space, you'll have companies dipping in and out of the various platforms as they grow. And a company that was raised on, you know, its first round of equity finance on Seedrs, very appropriate, should have been equity, wasn't eligible for debt. 4 years later, with 3 years of trading history, would maybe perfect for Funding Circle.
So from your perspective, when you talk with entrepreneurs, do you sort of steer one way or the other, or do you think that certain businesses are better suited for one or the other? What's your view?
I think it depends on the stage of the business cycle they're at. If they have a way of giving a payment guarantee, then obviously taking debt finance makes sense rather than giving equity in your business. However, if they're not in a position to take debt finance, they may have to give away equity and they're looking for investors. But if I could take the question one stage further, may I ask the audience, how many of you are founders of businesses? So quite a few. How many of you have a mobile phone? So my view on the way finance is changing, that it has to be done on mobiles. And I think companies like Seedrs and Funding Circle will eventually evolve to providing everything on mobile technologies. If you look around the room, we're doing everything on our mobile. And from an entrepreneur's perspective, if you're able to access money quickly and safely, and you're able to use your mobile to do that, why not do that? So I think there's a lot of things to think through here, but from an investor's perspective, you want to be investing in the most successful, most nimble companies that are looking towards the future. So you're more likely to finance those companies that are more innovative and being able to use mobile technologies. So that's one aspect, I think, of how things will change. How many of you have heard of BrewDog? Hopefully a few. Now, again, I think there's a big change here. In time to come, with no disrespect, we won't need intermediaries. Those companies that are really, really clever will choose whether they want debt finance or equity finance, and they'll do it themselves. Why not follow? This is the future. I'm not talking about immediately, in time to come. And this is, a thing we need to be thinking about, because when we access the really clever entrepreneurs, they know what they're doing, and they'd rather do it themselves than having to go and elsewhere. But we're talking about the creme de la creme. So I see trends changing. And if you are a really, really hotshot business with great marketing skills, why not do it yourself? Why not go to your crowd, to your audience, and borrow the money from them? They will be equity owners in your businesses. They will help your businesses become more successful. I'm playing devil's advocate to a certain extent, but I do think there is a lot of change that could happen.
I mean, you know, I just hear the ghost of Adam Smith, which is weird, saying, well, no, like, you are really good. If you are really good at running this business, why not partner with someone who's really good at running a securities or loan platform, running the compliance traps, et cetera, et cetera. Just to play devil's advocate? I don't know how, angel's advocate?
That's probably a very English word.
I think, and probably what you're saying is more true of kind of equity investment, because actually a platform particularly, you know, does a lot more than introduce the debt. There's all the collections and the servicing, and then that's kind of what the platform's doing. But I completely agree. Obviously, though, I think one of the reasons we talk about innovative finance is things will change constantly. And again, it's one of the challenges that I think we have in terms of regulation, because things will change constantly because people have great ideas. Completely agree that to have an effective platform, you've certainly got to be able to access it from the mobile, and more as we see, and here, but more so in other countries. If you're not on mobile, then people in certain countries people don't do anything other than on mobile because they don't have computers really. So you've really got to have that, and it's got to be something that works, and that's not always easy because it's a small thing. So you've got to be able to have those different technologies.
My point is, I mean, the people, my colleagues here, they're very successful because they're great at marketing as well. It's the execution, but actually you've had the ability to get your name out there, and you do this continuously. So I think we can follow, as entrepreneurs, we can follow in that trend, and obviously form partnerships where needed, but also look at doing it ourselves.
Sure. So we mentioned, we've talked about investors, but we haven't really drilled down. And of course, without the investor, there's no money, and this is all pointless. So in terms of what you're seeing from investors, what are you seeing in terms of who's making these investments? Is it changing, or is it moving from, the small customer of the store who just really likes this artisanal cheese to, is that where we're at, or are we seeing more and more banks and other institutions moving forward? Where are you seeing your money coming from now and in the future?
I don't think it's from one place. The £10 minimum is a marketing strapline, but there's also an important messaging point there. And the average size of investment on Seedrs is £1,200 at the moment. The median is around 200. And we have a lot of £10 investors trying it out, putting 50 quid here and there. But we've also had a £280,000 investment go into one company. We also are starting to see venture capitalists as institutions using Seedrs. And we see institutional capital being an important part of our growth, particularly when we can start showing returns and returns data. And I would love to hear the debt side of it, because I'm sure that's similar. And I think that institutional capital and retail capital has always played well together, actually, if it's in the right setting. And we're really building ourselves to not be sort of snobs about where it comes from. And I think capital is capital, particularly from the entrepreneur's perspective. I think what we're keen to do is build a structure that means that it's irrelevant from the entrepreneur's perspective where the capital comes from, as long as that capital is a benefit, not a burden, which is kind of our focus.
Yeah, and I'd echo that definitely, and I think it also depends on where the marketplace is, what jurisdiction you're in, because there is different rules around who can and can't lend, very different between the UK and the US. In the UK, our marketplace was very much built on retail in the early days. Extremely important to the growth of the marketplace, and will remain growth. But what we want to see, our vision is about, a marketplace where anybody can lend. And that means that for the small businesses, diversification of the capital sources is incredibly important. So we've started with talking to a number of financiers who might put leverage finance in. You may have seen announced in the press that that there's a listed fund being launched that will lend through the Funding Circle platform. And then we want to go to greater diversification, so to pension funds, etc. So that because what is really important, that there is that diversification of funding, so that we can lend to more and more small businesses. Because what we don't want is these small businesses being reliant on a really small amount of funding, which if we stuck with retail would be much smaller, and we wouldn't be able to scale in the way that we want to. But again, I totally agree that actually being able to bring all those different sources together is what makes the marketplace model such an exciting thing to be involved in. And actually, I think we may be talking about it later on, but the traditional sources of finance, so the banks, etc., I think will also find it actually quite a useful source to lend through. And it's been, again, announced that Metro Bank have done a deal to lend through the Zopa platform. And we're talking both in the UK and the US to banks and traditional sources of finance, because they're restricted from doing it themselves, and actually see this as a very good way to deploy their capital. So all that is just bringing more and more to those small businesses who want that financing quickly, and is just really important to us as we build those different sources of funding.
Yeah, I mean, it's been an interesting journey. 6-7 years ago, when the business launched, I wasn't there, but I know many other founders very well, and they hung out their shingle there, and no respectable financial institution in the US would go near them. I'm kind of going, wow, what is this stuff, and what are you guys doing? And I know that's the experience of many of us over the last few years, and I think that's changed a lot, which is very welcome. and very good, because I think the banks are and many of the traditional financial institutions are seeing this use of technology as something that they want to be a part of rather than resist, which I think is very wise. I think one of the interesting things you talk about investors, where the innovation actually shows, and I salute Funding Circle for this, but there's a huge amount of transparency and openness in terms of the actual lending that's happening, which you would never see in a traditional bank, right? So if you're an investor in Funding Circle, you can download the loan book. Every single transaction has ever happened, right? And you can go through it and see the performance and see what loans they did. So if you're an investor, you can make up your own mind on that and have your analysts, et cetera, kind of look at that and go, okay, well, I want to invest in this particular sector or these types of businesses or these loans. That's incredibly powerful, and technology enables that. And that's something that's adding value to this matching component between lenders and borrowers, or between, on the equity side as well, which is not something that, would have been done in the past. You might have been a bank investor, you have no idea what the bank is doing. The regulator hardly has any idea what the bank is doing. So I think this level of transparency and openness is a really good thing, basically, because I think that will help as these platforms, hopefully, touch wood, grow bigger. It'll kind of tone down this idea that, well, what happens if one of them gets too big and they fail, right? Because if that openness is there, you will see investors kind of go, okay, well, this is getting a little bit too scary or too risky. I'm not quite happy with that. That progression will happen in a more open fashion, is my sense.
So we've been talking about institutional investors, and so let's keep the ball rolling in terms of how do you see traditional finance reacting to this? I mean, in the United States, our Treasury Department just closed their comment period for request for information, and at least some more traditional players, I'm thinking about, say, our community banks, their comment letters were sharp-edged, shall we say. Whereas, on the other hand, you are seeing a significant amount of traditional players putting money into the space. So from your view, and let me back up, of course, if you read the tech press, it's all X is killing Y bank, or banking is dead and we should all just forget about it. And that might be a little overblown, maybe, we'll see. So from your perspectives, where do you see this going? Do you see traditional finance as competitor, partner, acquirer, you will acquire them? Like, where do you see it going?
Everything but the last one.
Okay. Dream big.
I think. I mean, interestingly, we have been a startup over the last few years, needing to raise money from the traditional methods of finance. So it's always been a very strange and interesting dynamic where you're going to the people who you're trying to disrupt, saying, "Can you give me some money?" And they really didn't like us at the start, and they often thought you're idiots, you're never going to get regulated, and what the hell are you talking about? And I think as things have changed very, very quickly, the smart ones are now getting on board and realizing, actually, this is an opportunity, because from the angel community perspective, we're not really disrupting them. We're giving them more deal flow. There's nothing stopping them using Seedrs to deploy their capital. We offer a great matched funding, co-investment type structure. The VCs will always serve a very, very important place. And actually, I don't really see us disrupting them. I think what we're doing, again, is increasing deal flow for them. And where I think there's probably more of a tension, if I'm honest, is as you creep into the public markets side of things, and the traditional broker model, where there's a very large amount of capital controlled by a very, very small amount of people who essentially can charge fees for access, and that's it. And I think fees for access is something that I think will not be able to last too much longer. And I think that's where we are disrupting, because you don't need to charge for access. You can charge for advice, you can charge for skills in picking the right ones, but just charging for access is something I think that won't last much longer.
On the lending side?
In terms of?
Where do you see your relations with traditional capital?
Yeah, I mean, I think it's more complementary, I think, particularly with the larger banks, because I think they realize, the cost to serve, in our case, again, small business is just too high. So think about, the BAL regulations, et cetera. incentivize you to lend to a secured loan, a property loan, because the risk weighting for that is much lower. It's 4 or 5 times lower than to lend to a small business. So what's a big bank going to do? It's going to lend more to property and less to small business. So that, that whole incentive is very skewed. And the cost to make a, $40,000 loan is probably the same as to make a $2.5 million loan. So again, what are they going to do? They're going to do the larger loans. So that creates a gap and a space there. And so now they're looking at platforms, like ourselves, and thinking, well, actually, how can we boost your business? Can we lend to these businesses via yourselves, right? By funding your loan book or by buying your loans, et cetera. And we've announced a couple of those transactions in the US with some of the major banks, and I would anticipate we'll be doing more of them as well.
I agree. I think there's a much more of a move towards it being seen as complementary, whether in terms of referral partnerships, where we've historically had some relationships, and there's work there to do to make sure that people are aware that we get in touch with the people within the bank, so that the referrals are actually being made. But I think we will see a move more and more to actually wanting to lend through the platform. Because it is so difficult and so expensive to make these small business loans. Having said that, and I think that's both we see it in our business both in the UK and the US, where we're talking to a number of banks in the US as well about lending through the platform. Fully aware of the comments made in response to the US Treasury. But I think that is the challenge where I'm sure there will be pushback in terms of what they might see as lighter regulation. But I think the reality is there, and I think the better view and the better financial institutions will see it as an ability, an opportunity, and an ability to enhance what they can offer to their customers, because there are many things that a bank will offer that a marketplace won't offer, and we can do quickly, cheaply, transparently what they are struggling to do. So I think the better view of the better institutions will be that it's more of a complementary opportunity.
So from your perspective, as not a platform, but somewhat looking at them across spectrum, where do you see this going vis-a-vis the traditional finance?
I do think the banks will find it difficult to survive unless they do partner with the new innovative firms, simply because as Lucy and Tom, everybody's been saying, and Rob's been saying, it's too expensive. It's just too expensive to run the traditional financial institutions. So they have to become more creative and innovative in the way that they do things, and one is partnering, other one is looking at new products. The other angle I'd like to just bring into this is my business is backed by a company called LDC, Lloyds TSB Development Capital. So they sponsor the not-for-profit arm of the organization, and I'm seeing a lot more of corporate venturing. So I think the banks need to be working with the large corporates and also the likes of the innovative platforms to be able to survive. So I think that's something that we should think about is how the big institutional companies, not necessarily financial institutions, can partner with financial institutions in terms of lending and also on the private equity side.
So we've danced around it, but let's just turn into it now, and that is regulation. Because certainly in the and one thing that strikes me as interesting as an American is all the discussion of how, you won't get regulated, as if it's this bad thing. Whereas in America, there's a lot of I don't want to get regulated, don't regulate me, let me just kind of do my thing. And then finally the music stops and you don't have a chair and you're regulated. So let's talk about how regulation is impacting this business, how regulation is shaping and driving, and what the relationship with the regulators are. And you're all in multiple countries. And I understand that there are arguably perhaps different experiences depending on who you're dealing with. So, I don't think anyone in America can see you right now. So now's the time to be honest. From your perspectives, how is regulation driving this?
The first comment to make, I think, is that there is a lot of regulation in the US. There might not be specific regulation, but there's huge, complex regulation. I think that's one of the points. If you're in financial services, you are regulated at borrower and lender level completely, whether it's both at state and federal level. So there's a lot of regulation there. In terms of the UK, and I think what I think is an interesting model going forward in terms of the way that the regulation has come about here for the more innovative platforms. I mean, Funding Circle in particular was really instrumental in lobbying for regulation, so it is really, really important for the industry. And along with the other main platforms in the early days, formed the P2PFA, and I think it was very important to have that industry body with the shared voice to actually go and speak to Treasury and to the FCA. And actually, Treasury and the FCA have shown themselves to be really supportive of, or at least trying to be supportive of supporting that innovation, particularly Treasury and the FCA. They formed the Innovation Hub, and I think there's a lot they've done, and they've brought in what I think is certainly on the lending side, pretty balanced regulation. Having said all that, a small company having to comply with the full FCA handbook is a nightmare, and it's expensive and it's difficult. With the companies that are the size of ours now, whether it's Funding Circle or Seedrs, a lot of this stuff, compliance stuff, we'd want to be doing now anyway. But a small company coming in and having to go through FCA authorization is huge. And there are thoughts that there could there be something that's more, kind of specific to an industry, so specific handbooks for an industry, so they're not having to deal with the whole remit of this regulation that effectively is what banks are dealing with. And also the question of how you can put specific regulations in to cover innovative business models, where the business models across just the small lending platforms, the business models are all different. So to put that regulation in that will work in 2 years' time when technologies evolve more and there's been more innovation is a real challenge. And I think that's going to be a challenge for the regulator to keep it on top of. But those are the complexities that nobody thought of, and things will have to change and we'll have to keep talking. But having said that, I think it's been done really, really well in the UK. And I really hope that in Europe that will be followed and there won't be over-regulation. And I hope that there won't be a kind of an adverse reaction in the US to kind of bring in lots of new regulation and retention rules and all of that kind of thing, which I don't think is necessary in this world where there is actually already quite a lot of financial regulation. But even in the US, I think it wouldn't be a problem to have some clearer regulation so that people are very, understanding where they are, as long as it doesn't go the other way and go into really complex regulation, which is what we're actually seeing in some European countries, where they're bringing regulation in, which actually is sort of gone over the top. And equally, I think you can see an example of somewhere like China where there was no regulation and the kind of the disaster that's happened in that marketplace, because actually it's much harder to bring regulation in once the industry is there and established to try and redress the problems that come if you don't have regulation. So I think it's always going to be a really hard balance, but I think it's not been done as well as it could be in the UK.
Yeah, I mean, I agree with all of that. I mean, particularly around the FCA, I mean, you can imagine Jeff Flynn, our CEO, walking into the FCA's office 5.5 years ago going, I've got this idea for a platform. And you can imagine their reaction, just on earth are you talking about, get out. And they embraced it, and it took a long time, and it was hugely inefficient, and it was painful. Of course it was. I mean, it's government regulation. But they got there in the end. I think just the overriding comment I'd make is the reason I think why we're all embracing regulation is I think we are all, and I am in particular, paranoid about the space. It's a very fragile, very new industry which can go as quickly as it came if we're not careful. And I think most of the players in the market are quite responsible platforms because they recognize that. And particularly in the equity space, I mean, we're operating a platform where investors are going to have a relationship with that company and that investment longer than the average marriage. We're talking about 5 to 10 years before they see a return.
I've just hit 5 years on my marriage. Don't tell me.
Unless you're responsible and looking after this, and if the founders of the equity crowdfunding platform are looking to just flip and sell before there's even been the first exit, that's kind of not what we're about. And we see the huge potential here, but we also see the huge pitfalls. And for us, it's all about protecting the space, and regulation is an important part of that.
Yeah, I mean, I think from our US experience, we kind of look at the UK and kind of with wishful thinking. Sometimes, I know some of my colleagues on the regulatory side and the legal side, Not because the regulation is easier or harder in the UK, it's just because it's more defined kind of who you go and talk to and who the agencies responsible are, whereas the US is kind of evolved. So, I echo Lucy's comments. The US is a complex regulatory environment, and it's not clear who the agencies are. And when you're innovating, when you're using online data and you're using, your customer isn't physically there, you've never visited them, or you're, transacting with them electronically, that kind of breaks through all sorts of rules that have been going back 30, 40 years and aren't really ready for this era. So that makes things complicated. But I agree with your comment as well. The reason a lot of these platforms we have to embrace, there's no escape from it, we have to embrace regulation. And obviously, A, because it's good practice for our business, but B, because it helps to build trust. What we need to build so that we can scale our businesses is so that small business owner, that consumer that's looking, or that person that's looking for credit can look at these platforms with confidence and go, okay, I trust that they'll be around, or that they'll treat my data sensitively, or that they'll do good business practices, and you achieve that a lot through regulation. So there's, involved in financial services, there's no escaping that, and trust is a key part of the equation.
So there's been a lot of positive talk about the future of this. So let's put an end to that and talk about where it might all go wrong. Where do you see the risks of this industry? Now, we touched on a little bit about that, but and is it a bad actor problem, or is it a economic environment problem? I mean, in the United States, we've had interest rates that have been historically low for almost as long as I can remember. Where do you see the potential risks, and how do you think they can be addressed?
Yeah,
absolutely.
From the entrepreneur's angle, for the entrepreneur, I think it's quite a difficult one. You want to have enough regulation there to feel protected, but you don't want too much red tape when you're making the application for either the equity funding or the debt funding. So it's a really, really fine balance. And as a founder myself, I would prefer to go to a regulated company because I know that they're managing their practices within the guidelines. But at the same time, I don't want to go somewhere where it's going to take me twice as long. Mm-hmm. So I think as we increase regulation, we need to look quite carefully on the impact of that regulation in terms of red tape, and does it actually slow down business? That's the entrepreneur's sort of angle.
I think in terms of risks, generally, there are all the risks that would apply in any business, particularly any kind of technology business. So there's data breach, there's fraud, there's financial crime, and all those things. And I think the bigger risk for an industry like ours is because it's relatively new and it's different. And if that happens to a big player, then it will impact hugely. And you can't stop that. You can make sure that you've got the regulation helps with that, because you have to have the systems and controls in place there. But it's much harder for the smaller companies. And of course, people are holding a lot of investors' money. Platforms like ours, we hold a lot of client money, and there are regulatory protections around that. But if a platform goes down, as we have seen and will see, then it's going to have a big impact. And I think regulation really helps with that, because it does help with that trust. But actually, the press around a rogue player going down will do a lot of damage, and we'll all have to deal with that. And then there's the market conditions. It's been, I think as we said before, quite a perfect storm in terms of the market conditions here and the banks retrenching. It's been a really great environment for these people like us and all of us here to grow. That will be more challenging if market conditions change. But we all plan for that. We're all going to be businesses that we fully believe that things will change in the market, but we will deal with that. And if there's something enormous that happens, then we're all in the same place anyway. So I think there's a real mix of risks. But for me, the one that worries me is either something kind of outside of control, or a rogue player having a big issue in terms of investors' money, and it comes back entirely to the trust point that we're talking about, because then people will become more nervous. So I think there needs to be, people are becoming more and more confident in the model, and more kind of, and regulation, as we said, helps that, but that could be damaged quite quickly.
Yeah, I think, to an extent, the sector is very hot. It's very, there's a lot of attention, there's a lot of media coverage, there's a lot of, dare I say, hype around it. And, that creates a danger, because then when that bubble, when a little thing goes off, it kind of deflates everyone's expectations, and they go, oh, right, I knew that was going to happen, right? I think the reality over a 5, 10, 15-year period, this sector is, part of natural evolution. Again, look at what's happening in e-commerce or mobile, etc. So that's there, but in the super short term, there's just, whether it's valuations or whether it's, attention, the economic impact of the sector hasn't been as strong as what the newsworthiness of the sector yet. But I think it'll catch up, and it'll then surpass even what a lot of us in the industry think the sector can achieve. So it's just that kind of mismatch is.
Yeah, no, I agree with that. I mean, it's interesting actually, in the true British press way. I think we've all enjoyed the last few years of building us up, and now we're starting to see them knock us down. And already, you're starting to see those sort of headlines, and is this the next scandal? I think from my perspective, from the equity side, we've got to prove and stay whiter than white for the next few years until those returns start to come in. Because the proof will be in the pudding. The proof will be in those returns, and I sometimes wish we were in the debt space where we can prove returns each month. We can't do that. And I think in my own personal concern in the equity crowdfunding space is there are some platforms out there that perhaps aren't taking that as seriously as others, but they can get away with it because it's kind of hidden, the skeletons are in the closet. And it's only really when, weirdly, some commercial successes will come through, and unless those crowdfunding investors actually make some money, then we might as well go home.
All right, so we're almost out of time, but let's not end it on a down note. Let's be optimistic, stiff upper lip. Where do you see this going? Where do you see innovative finance going in 5 years? What do you think, when we do this again 5 years from now, what are we talking about?
From my perspective, it will no longer be alternative finance. It will just be finance.
I think mobile finance will be much more on the agenda. I think companies raising their own finance through their own means, whether they white label, Funding Circle or Seedrs, I see a lot more of that happening in the next 5 years.
I think just increased diversity of funding. I think make sure that everybody feels they can access that platform, cross-border funding. Just that increase, so that it's there as a totally long-term viable alternative source of alternative, but another normal source of finance for any business.
Give you the last word.
Well, I hope for a future where basically there's more. The banks have 80% market share, right? So of lending. So I think if that's more diversified in the next few years, that will be a good thing. To regulation. What's the point of regulation? One is consumer protection, but the other is enhanced competition. And so we need more of that competition, both what we do as platforms, and hopefully we do a good job of convincing our customers to choose us more. So.
Sounds good. Well, I'd like to thank my panelists for providing a really thoughtful and interesting conversation. I look forward to the 5-year retrospective on this, where hopefully I'll still be married. Anyway, thank you all for attending, and thank you all for providing such wonderful information, and hope that everyone enjoys the rest of the summit.